Conceptual Framework for Financial Reporting. Introduction. The Conceptual Framework for Financial Reporting is the foundation of IFRS. It provides guiding principles for the development of accounting standards and helps preparers of financial statements apply these standards consistently. While it is not an accounting standard itself, it serves as a reference for resolving accounting issues when no specific IFRS standard applies. One purpose of the Conceptual Framework. The primary objective of financial reporting is to provide useful financial information to investors, lenders, and other users to help them make informed decisions. Financial statements should provide insight into an entity's financial position, assets, liabilities, and equity, its financial performance, income and expenses, cash flows, and resource management. It also helps standard setters like the International Accounting Standards Board, IASB, develop consistent, high-quality standards. 2 qualitative characteristics of financial. Fundamental qualitative characteristics. Relevance. Information must influence users' decisions by confirming past evaluations or helping predict future outcomes. Includes materiality, meaning significant information should not be omitted. Faithful representation. Information must accurately depict reality and be complete, no missing details. Neutral, unbiased, free from error, as accurate as possible. Enhancing qualitative characteristics. These characteristics improve the usefulness of relevant and faithfully represented information. Comparability allows users to compare financial statements across companies and time periods. Verifiability ensures information can be confirmed by independent sources. Timeliness. Financial information should be available before it loses relevance. Understandability. Information should be presented clearly and concisely. 3 elements of financial statements. The 5 key elements defined in the Conceptual Framework are assets, resources controlled by the entity that provide future economic benefits. Liabilities, present obligations that will result in an outflow of resources. Equity, the residual interest in assets after deducting liabilities. Income, increases in economic benefits, leading to an increase in equity, excluding owner contributions. Expenses, decreases in economic benefits, reducing equity. 4 recognition and derecognition of elements. Recognition criteria. An item is recognized in the financial statements if it meets the definition of an element, asset, liability, income, etc. It is probable that future economic benefits will flow to or from the entity. It can be measured reliably. Derecognition. An item is derecognized when it no longer meets the definition of an element. For example, an asset is derecognized when control is lost, e.g. when sold. A liability is derecognized when settled or canceled. 5 measurement bases. Measurement refers to how items are valued in the financial statements. The main bases are historical cost. Assets and liabilities are recorded at their original purchase price. Current value approaches. Fair value, the price that would be received to sell an asset or paid to transfer a liability. Value in use, the present value of future cash flows expected from an asset. Current cost, the cost of acquiring an equivalent asset at present. 6 going concern assumption. The going concern assumption states that financial statements are prepared under the assumption that the entity will continue operating in the foreseeable future. If an entity is not a going concern, financial statements must be prepared using a liquidation basis instead. 7 capital and capital maintenance. The Conceptual Framework identifies 2 approaches to maintaining capital. Financial capital maintenance, profit is measured by the increase in net assets. Physical capital maintenance, profit is measured by the entity's ability to maintain its productive capacity. Exam tips and key takeaways. Objective, understand that the Conceptual Framework provides the foundation for financial reporting, but is not a standard itself. Key qualitative characteristics. Relevance and faithful representation fundamental, plus comparability, verifiability, timeliness, and understandability enhancing. Elements of financial statements, assets, liabilities, equity, income, and expenses. Recognition criteria, definition, probability, and reliable measurement. Measurement bases, historical cost versus current value, fair value, value in use, and current cost. Going concern. If the entity is expected to continue operating, financial statements are prepared accordingly. If not, the liquidation basis is used. Test your knowledge. Multiple choice questions. Q1. Which of the following is a fundamental qualitative characteristic of financial information? Comparability, relevance, timeliness, verifiability. Q2. When is an asset recognized in the financial statements? When it is probable that economic benefits will flow to the entity and its cost can be measured reliably. B. Only when cash is received for it. C. When it has been in use for more than 1 financial year. D. When the entity legally owns it. Q3. The going concern assumption means A. An entity must prepare financial statements assuming it will continue operating in the foreseeable future. B. All entities must continue operating indefinitely. C. An entity must maintain its assets at fair value. D. The financial statements should always be prepared using historical cost. Leave your answers in the comments. Did you get them right? Let us know in the comments. Also, if this helped you, don't forget to like the video, share with your friends, subscribe for more study tips and accounting content. Final thoughts. Studying the Conceptual Framework is key to mastering financial reporting, FR. Understanding its principles will help you answer both objective and scenario-based exam questions confidently. Keep practicing, and let's get you closer to passing your exam.